Right, today being the first day of the year, which I'm sharing, starting this Monday night sharing again. I want to talk a bit about the currency trading strategy for 2025 based on central banks' interest rates. Now, before I dwell into it, I want to remind everyone that this particular sharing here is based upon the contingency that the whatever that is being shared in the news is as it is. As we know, things never stay. There are always changes when there are news coming up, right? So economic news coming up. So but nevertheless, whatever is being mentioned in the last 1.5 months, I've summed it up and I'm using that as a basis to give you an idea how shall we trade for 2025. Now, again, I want to remind everyone, this is as long, it's okay as long as there are no changes to the predictions of the market with. Okay, so let's look into this. Anyway, an overview first. What we have here is the list of all the rates by all the banks of the major economies. This is the US, the Federal Reserve, the European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, Reserve Bank of Australia, Reserve Bank of New Zealand, Bank of Canada. This is the current interest rates. Okay, now these are the estimated rates. Now, what I'm trying to say just now is that how to trade the market is based entirely upon this prediction here. Now, if the number changes, then things might change. Okay, so this is the number of cuts or hike expected. If it's a negative, that means they're going to cut. If it's a positive, they're going to hike rates. Okay, now total rate changes, it's here. The rate of change of these rates compared to previous number is here, and the expected month that the rates would be cut is listed here. Okay, so why is this important in the first place? Now, interest rates set by central banks directly influence the attractiveness of currencies in the global Forex market. Investors and traders often look to capitalize on rate differentials between countries to maximize return on currency investments. Now, with the expected interest rate changes in 2025, several strategic opportunities arise for Forex traders. Here's an analysis focusing on projected strengths and weaknesses of individual currencies based on expected monetary policies and how traders can approach trading them. Now, first of all, let's look into the trading strategies for the different currencies. Now, the first one is the United States dollar. Strategy for now, cautious buying, because the Fed is saying that probably they will be cutting rates only twice. The bond market is saying 3 times, but I'm putting in what the Fed is saying. The bond market has its right to say what it is, but I'm staying with the Fed at the current moment. I know that it can probably change following the bond market. Nevertheless, if you were to compare the rates, interest rates, the US dollar still remains very, very high. Okay, and that's the reason why I said if you want to buy, can, but we have to be cautious with the buying. The rationale is the Fed is expected to make modest rate cuts, which typically would weaken the US dollars. However, due to the strength of the US economy and its safe haven status, large downward movements might be limited. Traders should look for opportunities to buy on dips rather than committing to long-term bullish positions. All right. For the euro dollar, the strategy is selling on rallies. Rationale: with significant rate cuts expected from the ECB, i.e. the European Central Bank, the euro is likely to weaken against its major counterparts. Traders should focus on selling the euro dollar on any short-term rallies, especially against currencies of nations with stable or increasing rates. Okay. For the British pound, strategy is mixed, which means there's the possibility that we might see ranging positions for certain pairs. Not everything, for certain pairings. Okay. The rationale, the BOE, moderate approach to rate changes, suggests a relatively stable outlook for the pound. Traders might find opportunities in cross-currency pairs where the other currency is expected to experience greater volatility. Okay. Now for the Japanese yen, right? Strategy, long positions. Rationale, as the Bank of Japan plans to increase rates, a rare move for Japan, the yen could strengthen significantly. Traders should consider long positions in the Japanese yen, particularly against weaker currencies like the euro or the Canadian dollar. For the Swiss franc, strategy, short positions, right? Rationale, with a significant reduction in interest rates planned by the Swiss National Bank, the Swiss franc is expected to depreciate. Short selling Swiss franc against stronger currencies could yield profits. As for the Australian dollar and New Zealand dollar, strategy, short to mid-term buying. Both Aussie and New Zealand are seeing rate cuts, but the economies are likely to attract investments due to their commodity-based exports and higher yields relative to other developed nations. Traders might benefit from short to medium-term buys, especially in pairs against weaker currencies. Okay. Lastly, the Canadian dollar strategy selling. With aggressive rate cuts planned, the CAD is likely to weaken. Traders should look for opportunities to sell CAD, Canadian dollar, particularly in pairs with currencies expecting rate hikes or stable rates. Additional considerations here. Economic indicators besides interest rates, traders should also monitor employment figures, GDP growth, inflation rates, and consumer spending within these economies, as they can significantly influence central bank decisions and currency strengths. Political stability, changes in government policies, elections, and international relations can also impact economic stability and influence currency markets. Now, as for global events, keep an eye on global events such as trade deals, or like the trade wars that could happen between China and US, the real war that's going on, the Ukrainian war and the war in Gaza and Syria, or significant policy changes in major economies like China and the US, as these can cause sudden shifts in currency values. Okay, so